Okay, so we're back with another video on last in, first out. Now we're going to look at the periodic method. And what happens with the periodic method is that, of course, we don't calculate the value after every transaction as we just did with the perpetual method. In this case, what we do is we look at our ending units, we look at our cost of goods available for sale, and our ending inventory balance to determine everything else, to determine our cost of goods sold. Okay, and so similar to what we did with FIFO, what happens is, if you think about it, when we are using the last in first out method, that means that the last set of purchases we made were probably already used up. So normally what happens is we have to start with the purchases that may be left over if there is a balance in inventory, which would always be the beginning balance or the first purchase made for the month. We start from the beginning balance and then we move down when we're calculating our ending inventory. So again, we should remember when we did the perpetual inventory method, what we would have realized is we ended up all the way up here towards the end of the month using this layer here. And so that means that that's the layer that we're going to look at when we're trying to value our ending inventory. So our ending inventory, our ending units actually, is 95 units still. And so this 95 units, when we look at it, we starting from this layer here going down. So this, the opening balance, then going down. Opening inventory balance is 500 units. We definitely didn't use all of the 500 units because we have 95 left. And so what that means is that the value that we need to place per unit is going to be the value assigned to this 500, which is the $10. So the value is per unit is going to be $10. So what that means is then to calculate our ending inventory, we'd have to take 95 times $10, which will give us $950. Same as with the perpetual system, we have the same $950. That means most likely that the cost of goods sold is going to be the same as well. But we just have to calculate it just to show you how to calculate it in the event you don't do all of this before you calculate it periodically. Okay, so cost of goods available for sale. Cost of goods available for sale is what's necessary in order for us to calculate our cost of goods sold. We already have our ending inventory. We need cost of goods available for sale. And based on our formula here, you would remember that cost of goods available for sale is beginning inventory plus purchases. And so this is the value of that. So cost of goods available for sale is the 5,000 opening balance plus all of the purchases, 840, 525, and 1,400. So that is our cost of goods available for sale, and therefore plug it into the formula. Our cost of goods sold is equal to the 765 minus 950. And so the value that we're going to report on our income statement as cost of goods sold for the month of July is going to be $6,815. And so, yes, this is the periodic method of accounting for inventory, last in, first out method. I think take this out here with the LIFO method just to mimic what we did in the FIFO video. For LIFO, the ending inventory doesn't come from the last layers. It comes from the first layers. And so similar to with the LIFO method, if we had, let's just say we had ending inventory units of 950 units, then we would have started 500 of them would have come from this $10 layer, then another 70 from this $12 layer, another 50 from this $10.50 layer until we get back to the amount of inventory in total that we have at the end of the month. So it just starts in the opposite direction from the top going down. So this is the end of the series of videos on inventory evaluation methods. So I hope this video has been helpful. If there are any questions, feel free to send me your questions, and I can always try to assist as best as I can.